Hello everyone, Lisa Crosta here, Senior Wealth Advisor and Director of Financial Planning at Crescent Harbor Private Wealth. Today we're going to take some time to talk about long-term care expenses and long-term care insurance. It's a topic that a lot of clients tend to put off. It's not the most fun thing to think about if you're going to need help when you're older with daily activities. But it's also really important to talk about for our parents because a lot of times there's care needed for elder parents and we may not have been planned for that. I want to cover the whole broad topic of long-term care expenses. We're going to talk about how people use their own money to self-insure. Maybe they use Medicare, or maybe they turn to insurance to cover it. Just some statistics too to begin with. About 70% of us, once we reach age 65, will need some form of long-term care. Women tend to use care for a little bit longer, 3.7 years, where men tend to use it for about 2.2 years. Care can be very expensive. Full-blown nursing home care, in a nursing home in the New York, New Jersey area is well over $140,000 a year. It's obviously less in other parts of the country, but it is still a big expense. So let's go through the different ways people attack these expenses and these thoughts, if you will. Self-insuring, it's the most straightforward. Do you have enough assets to cover this potential expense down the road? When we're doing planning, we can actually put projected expenses in the plan and see what it looks like if this money is being spent. If there's enough money there, that may be an answer for clients. Maybe they set that money aside, maybe they invest it slightly differently. But that's not an option for everyone. And interestingly enough, there are also clients who can self-insure, but decide not to because they want to transfer a portion of this risk of long-term care expenses to an insurance company. So they choose to buy the insurance sort of to take this weight off their shoulders, if you will, knowing that they have a bucket of insurance set aside. So we'll go into that as we go through the insurance options, but it's not simply a question of can I afford it on my own or can I not? Secondly, Medicare and Medicaid, I want to address that because there's often a little confusion. Medicare covers up to 100 days, that's it, of long-term care expenses, as long as that care is within 30 days of a hospital stay. So it's very limited coverage and for a limited period of time. Medicaid, on the other hand, does cover long-term care, but you have to have generally spent down the vast majority of your assets to qualify. Usually it's no more than about $2,000 in assets and limited income. Now keep in mind that varies by state. Some states let you keep a little more assets than other states, but really you have to spend down the vast majority of your assets to qualify for Medicaid. Family care, like taking care of your own family members, super common. There's over 6 million people in this country taking care of family members. It's great because you get your family taking care of you, but it can be difficult if the family you're taking care of lives far away. Maybe it's your parents and there's 3 siblings and one lives close, so they're doing all the care and the other kids aren't really putting in their share, so it can get difficult. You can also have siblings with different amounts of money, so who's going to contribute to mom or dad's care versus who cannot. Now, if it's you and your spouse and you're taking care of each other, but you're both getting old, it may not be feasible to take care of each other. So it sounds great, but it's just something I want clients to think through before we make that decision if that's the route you're going to go. So let's turn to the insurance options if you do decide to, as they say, transfer some of the risk to an insurance company. The first type of long-term care coverage is traditional, we call it. You pay for it every year, and it's a premium, and you pay for it throughout your lifetime. The negatives of this is that the premiums go up every year, just like your car insurance. And if you don't use it, the insurance company doesn't give you your money back. So it's every year you're going to pay, and every year you're going to generally pay more. And if you don't use long-term care, those premiums, just go away. Nobody calls you up and sends you the money back. The positives of this is that they're generally the least expensive insurance coverage is these traditional policies. That's one option. There's life insurance with long-term care rider. So you can add a rider on top of a permanent, not a term, insurance policy. And for example, if your insurance benefit was $1 million and you needed care during your lifetime, you can access some or all of that $1 million to cover long-term care expenses. So that can really be a great feature. The negative is that these policies are generally quite expensive and you're generally going to pay throughout your lifetime for these policies. But you don't have the risk of wasting money like you did with the first option because if you don't use care, the death benefit still goes to your heirs when you pass away. The third insurance option is more of a hybrid. You buy into these policies generally for a fixed period of time, 10, 15 years. Every state's a little different. and you will have a long-term care bucket of dollars. So if you set aside premiums for 10 years, you're going to have long-term care that's more than what you put in, because the insurance is going to give you leverage on that. If you die without using it, the money you paid in plus possibly a small rate of return will go back to your heirs. So there's no use it or lose it. That's the positive of that policy. Generally, you're not paying these your entire lifetime either, so that's also a positive. But they're not free. They're probably price-wise in between the two other policies I discussed. So these are all really valid options. And then keep in mind too, if you do decide to use insurance, you really want to buy it in your 50s, maybe your early 60s, because the longer you wait, the more expensive the policies are, and you have to qualify for these medically. So they're going to check medical records and prescriptions and do an interview. So you really want to make sure, well, it's easier to qualify when you're younger. If you've had a health event, it's much harder to get the insurance as you get older. So you don't want to bury your head in the sand for too long. You want to address this decision a little bit earlier. Those are the main things. The only thing I'll throw in there is I have had stories of clients that were firing health aides to take care of them because they didn't want to spend their inheritance money for their kids that they had set aside for their kids and worked so hard for. When they realized they had an insurance policy that could spend the insurance company's money and preserve their assets for their kids, they were much more apt to spend that money. So it's not just a what does it cost, what doesn't it cost decision. It's a lot more personal decision involved in deciding whether you want to buy long-term care or not. And these are the more in-depth conversations we'll have when you're planning with us here at Crescent Harbor. So reach out if you want to discuss any more, and have a great day. Thank you.